back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your questions this evening are Jean Pierre Verster from Protea Capital Management and Ricus from PSG Hole-in-One Ruimsig. If you'd like to send questions, please email stockwatch@bdtv.co.za or via SMS on 41392. Jean Pierre, Ricus, good evening to you both. It's a bit of deja vu because I feel like the three of us were together this time last week, Tuesday. So this evening, I shall start with you, Jean Pierre. We scraped into the green on the overall market today, and it seemed to be largely thanks to Naspers. And Naspers gaining just over 3%, Process just under 3%. What was that excitement about?
So most of the rise of Naspers and Process is because of a rise early this morning during the session that the Hong Kong Stock Exchange was open, because Tencent did relatively well. So quite a few technology-focused and China-focused stocks listed in Hong Kong did quite well. And then on the back of that, what usually happens when I wake up and I have my cup of coffee, Julieta, I have a quick look at the Tencent share price, because that's a very good indicator of what might happen to the Naspers and Process share price on the trading day on the JSE.
Ricus, I'll go to you and then back to you, Jean-Pierre. Do you get the sense that there's a bit more enthusiasm for Chinese shares, because they really have had a turgid couple of years, and they maybe haven't enjoyed, especially the tech stocks, haven't enjoyed the same sort of level of love that US tech stocks have enjoyed?
Yeah, I think in general there's possibly a little bit more positive sentiment towards the Chinese markets on the back of Chinese government introducing some measures to try and stabilize the market, basically. Tencent specifically, I think they are possibly going to work together with Apple to distribute, the new glasses, Vision Pro, in China, and Apple is also going into a deal with, I think, Baidu. So possibly that added to the positive sentiment towards Tencent this morning. In general, I'm still very doubtful about a real recovery in the Chinese market, and I think any turnaround possibly just being boosted by sentiment rather than reality on the ground.
Jean-Pierre, how are you feeling about some Chinese shares?
I'm going to come back to it again at the end of this show. But in short, I'll say that it has been, call it 2.5, 3 years of the Chinese market really underperforming after it did so well immediately post-COVID. Let's say the early stages of COVID, when they actually came out with a lot of stimulus. That's why the market at least did well. And then since then, it's been this 2.5, 3 year slide. And at some point, in general, let me first make the general point. In markets, you have two phenomena that tend to play out. The one is reversion to the mean, and the one is momentum, or you can call it a cycle or a trend. And when it comes to economies, they generally move in cycles, and stock markets follow that. But if you zoom out over the long term, an economy and a stock market follows a trend, an upward trend, because over time, the long term, economies grow, companies in aggregate grow, and therefore share prices in aggregate go up. So I think potentially we're near the end of a cyclical period of the economy not doing well in China and the stock market not doing well. But if you zoom out, I think we're still in a long-term trend of the Chinese economy still over the long term growing. And therefore, I expect a lot of companies, including Tencent, to get into the trough situation quite soon of earnings that went backwards, and actually in aggregate start growing earnings again. That would be good for share prices. So I do think we're potentially near a turning point in the Chinese market, because we're near a turning point in the Chinese economy, potentially.
Yeah. I wish we could say the same of the South African markets. And this is sort of a general question that a viewer has sent with regards to the upcoming elections, which are frighteningly close now. Can the panel shed some light, please, on the expectations of what will happen if the ANC has to go into coalition, and if the multi-party coalition gets into power after the upcoming election? What would the effect on the Rand and the JSE be? Ricus, is this an unknowable question at this point? I mean, imagine people have a few scenarios, but is there any point to them actually?
Yeah, I think things in general react to unexpected outcomes. I don't think there's anything majorly unexpected about the outcome of this election. It's going to be volatility because it's going to be driven by the news cycle itself. But there's, I think, little doubt that the governing party will still be pulling the strings post-election, even if it is in a coalition. It might not be as stable as it is now, where with stability, I mean things just generally deteriorating. So there might be an uncertainty surrounding what kind of deterioration we are seeing, but I don't think there's any doubt about the outcome. Therefore, I don't think there will be any major moves as a result of the election, unless something unexpected happens where the governing party really loses a lot of support and you all of a sudden get a power play that's far more severe than just having to work together or having to work with somebody in order to get its way.
Jean Pierre, I mean, are you setting yourself up for the unexpected? Is that even possible?
In a certain way, yes. So we've decreased our gross exposure in our funds, meaning that we've got more cash to decrease our risk of something unexpected happened, as Ricus says, and then markets react to that. And sometimes the reaction is not pleasant. So instead of making a bet effectively one way or the other, we are more conservative. I do believe that political power gives cover for shenanigans to happen in the civil service. And in short term, in a short phrase, what has happened is cadre deployment. And that has really weakened the government and the civil service to the point that it has damaged the economy. It's one thing to have a government that is potentially incompetent and doesn't contribute to growth. It's another to have a government that actually detracts from growth, because the incompetence turns into something worse, which is corruption. So if we can get to an outcome where someone loses political power, and therefore we lose political cover for cadre deployment, and we have some sort of professionalization in the civil service, and not just in the civil service, but at the local, municipal, provincial levels as well. That's where the rubber hits the road. Then potentially it could be a good outcome. What you don't want is a new political dominant power when the ANC goes into coalition with the EFF, for instance. So that is the key question. Will there be a loss of power? I think that'll be good. Or will there be a new dominant power, majority power, which will be even less capitalistic friendly, and that'll be bad. So because we're not sure which one of those two, we are more conservatively positioned in our funds.
Okay. This is maybe partly related, and it's a question on banks. And the viewer says most market commentators say banks are cheap. I don't understand. So let's say a bank has got 10 Rand owner's equity and 90 Rand borrowings from depositors. It lends the 100 out to various parties. If in the current economic circumstances of high interest rates, low growth, unemployment, and political uncertainty, let's say 15% of the debtor's book becomes doubtful or bad, then the bank is in trouble. Are they not highly geared investments rather than cheap? What am I missing? Ricus, I mean, the supposition is correct, but they're not at 15%, are they, of investments gone bad? It's more like 1.5%, right?
Yeah, I think the trick is there to make sure that you cater for your investments going bad, and that's a big part of banking. You always want to get more interest than you are paying out. The question is, are you going to get that interest? And that then depends on what your policy is towards possible bad debts. If you are prudent in that, you should be okay. Now and again, there's a banking crisis, and it turns out not to be okay. And and then banks are going to recapitalize themselves, which is why I'm not very fond of banks. But banks have been cheap, and then we get the last set of results from banks, and they are increasing that, shall we say, insurance against bad debt, as they've stated in, whether it be management or in the actual numbers themselves. And that decreases that little margin that you're getting between what you're lending out and what you're getting back in the form of interest.
Jean Pierre, am I correct in thinking that, it's generally closer to, if you're talking about credit impairments, I mean, the maximum that you might see from the big four, or the traditional four, would be 2% or 2.5%. So am I getting confused? You know, if you're talking about 15%, I don't think we've ever seen that in a South African bank, unless we're talking maybe about Sambo back in the early 2000s.
Correct. For a universal bank with both retail, secured and unsecured, as well as corporate type loans, it's more in that lower single digit level, the bad debts. I would make two additional points. The one is that remember that your net interest income, which is your margin, absorbs your bad debts. So if you are lending out at, call it 20%, and you're borrowing that money at, maybe you're paying 10% on all your deposits and other loans, you have a 10% interest margin. So you can absorb a 2, 3, 4, 5, 6% bad debt ratio because of your net interest margin. The wider your net interest margin, the more bad debts you can absorb. And the second point is that in general, for the universal banks, it's roughly 50-50 between net interest income and non-interest revenue. And that's much more annuity type based, your fees, insurance income, and other sources of income. So banks that are monoline, that only lend, yes, they are at higher risk to a spike in bad debts. But if you've got a wide net interest margin and significant non-interest revenue, then a bank is still levered, but not quite as levered as you would think it is when you compare a loan book that is 10 times the size to the equity value of the bank.
Yeah. And what I haven't asked either of you, I mean, Ricus, you said you don't really like banks, but do you think they're cheap?
No, they were viewed as a heck of a lot cheaper before they started talking about, we've got to increase debt provision, but by historical standards, they are not expensive. And when I say I don't like banks for the long term. But there is a time and a place for banks, so I'm fairly neutral at the moment on banks. I won't be chasing it. If I've got it, holding it, depending on the bank itself. But that's just splitting hairs.
Jean Pierre, are you equally lukewarm, or do you have a particular penchant either way?
So we invest globally. And a year ago, you might remember there was a bit of a banking wobble in the US, and a lot of banks around the world, the share prices fell. And at that point, we saw an opportunity in European banks. And we've done very well with those. They're up more than 50% on average to the banks that we bought a year ago. Sure. So we still have a preference for European banks because the economies in Europe are healthier than in South Africa. And the starting points were even cheaper than in South Africa. They were at a significant discount to their tangible net asset value. So we still have a slight preference to European banks, but in general, we like European and South African banks, not so much US banks because of the different structure of long-term interest rates that you can't really hedge in the US. The client can get a 20-year bond or mortgage at a fixed rate, and the bank takes that risk, which is different to Europe and South Africa. So we prefer Europe and South Africa.
We had a question from a viewer about European shares, and the viewer says, I have a small allocation to the Eurozone, which is about 20% of my portfolio. Can I have the panel's view on the following shares? ASML, SAP SE, Deutsche Bank, and ING Group. Ricus, I'll start with you. So there's, I suppose, at least one of the banks maybe Jean Pierre was talking about, but what do you think of that little collection?
I think from a quality perspective, I probably prefer ING. I like ASML. Might have had a bit too much of a run together with all the other tech names, but as far as that sector is concerned, I'm far more comfortable holding ASML. SAP, don't really follow that.
Okay. Jean Pierre, I mean, so did you look at either Deutsche Bank or ING? I don't know is ING strictly a bank or is it an insurance company?
It's a large financial services organization, so they do a bit of both. Look, I said I was bullish the European banks, but of the European banks, I prefer more simplistic banks. ING and Deutsche Bank are more complicated. So they're good, but I prefer other banks. In terms of ASML, I agree with Ricus. It happens to be listed in the Netherlands, but it's actually related and driven by the global semiconductor industry. And they've got such a strong position that the shares are expensive. But I've made the mistake myself for numerous times that you sell a great company's shares that look expensive, and a few years later, you wish you hadn't. And then finally on SAP, that one's a bit different. So when I looked at SAP not too long ago, it looked to me like a slow grower, Peter Lynch would call it. So they grow their earnings, but not at a very high rate. It's a very mature business. But all of a sudden, the share price has sort of exploded the last few months. And it seems to be because a lot of people are excited about their cloud offering and how they're going to integrate AI, because they've got so much data, access to so much data of organizations that's implemented SAP. I think potentially it could be a bit of over-optimism when it comes to SAP, if you look at their long-term track record. So that's the one that I'm not very bullish on.
Okay. And I suppose anyone in South Africa who's had to have a SAP rollout like SPAR would probably not be very bullish about SAP either. Okay, so moving on to famous brands. The viewer says, I like famous brands. I'd like to add it to my portfolio. Does the panel think that the valuation of the stock right now is at attractive levels to start buying? Ricus, it's bumbled along a bit. I mean, it's had some really tough years. It's had to unwind a few big mistakes.
Yeah, I think you've put your finger on that, where they seem to have lost the ability to control what they have in their portfolio, and as a result, have had to restructure. And you know, and if you're wasting your time on things that are going wrong, you've got less time to spend on things which are going right. Which is why I prefer Spur, which I've got in my portfolio rather than famous brands. So there is a recovery potential in famous brands, but as I tend to say about companies that I think which are fundamentally maybe cheap value-wise, what happens if the price goes up? Wonderfully, you've made a wonderful profit, but you're still sitting with a company that's underperforming on an operational basis. So you might make money in the short term, but is it a long-term holding if you compare it, for example, locally with something like Spur? And I would still prefer Spur.
Okay. Jean Pierre, do you have the same view of famous brands? Because, I mean, you could say maybe the days of poor operational performance are behind them. I don't know, or if you disagree with that, and whether or not you think the valuation's at, I suppose, a cheap enough level to tempt you anyway.
So we own both famous brands and Spur that Ricus touched on. But famous brands was my stock pick not too long ago. I think it was about a month ago, because I do think that they had the issues with Gourmet Burger Kitchen. But since then, the operating performance hasn't been bad. They've grown their profits again. The balance sheet was over-levered. They've come through that, I would call it a crisis, also unscathed. They did not need to do a rights issue. And they even started paying nice dividends again. So yes, it's been bumbling along, but the bumbling along, in my opinion, gives you an opportunity to buy shares in a company that I believe is a high-quality company. Okay. So I like famous brands a lot. I like Spur as well. Just on the valuation between the two at the moment, I've got a slight preference for famous brands, because I do believe that the worst of the issues are behind them.
Okay. Jean Pierre, I'll stick with you, but Ricus, I'll also get your view. The viewer says Jean Pierre's view on REITs on the JSE. Local or offshore exposure, and is he short any property shares?
We've got quite a few European REIT shorts for quite a while. So if you look at the interest rate cycle, there's been an enormous increase from a year ago and the few years up until a year ago. And a lot of European property companies have got maturities coming up where they need to refinance their debt, and they're going to refinance at much higher rates than what the locked-in rate was previously. So you've got pressure on the balance sheet. At the same time, you've got economic pressure putting pressure on rentals with negative reversions, and especially in the office sector, a lot of pressure. So we are short a number of European REITs, especially ones exposed to the office sector. We've made some very good money, especially in Sweden, being short a few REITs there, because in that market it was totally overheated. And you saw some property companies, their wheels falling off effectively. In South Africa, it's tougher. We're more neutral now. We had been short REITs a couple of years ago, but some of them have got such high yields and they're still making distribution. So even if the price does nothing, if you're shorting a REIT with a 10 to 12% distribution yield, it's costing you 10 to 12% to be short. Yeah. So I would say that there's actually been a few opportunities to go long. Atterbury Property or Attack is one that I think did a very good job in fixing their balance sheet and having growth prospects. So we like Attack, and we've got one small short in South Africa, but in South Africa I would be long REITs, and in Europe I'd still be short REITs.
Ricus, do you have any particular views on South African property shares, and if you were long any, which ones would you be buying?
I can only agree with him, JP. It's Attack as well. If I want to be in a South African, in the South African market, yeah.
All right, then I shall ask you about Shoprite. The stock's been losing traction over the last 3 months, says the viewer. What is the reason for this? Sticking with you, Ricus.
Consolidating recent gains, and people are probably saying, well, how much more market share can it take? And let's face it, it's not cheap. But I don't think there's anything specifically fundamentally wrong with it. It's just waiting for earnings to grow into the current reasonably highly priced value.
Does that mean you just hold on? You don't sell out? You know, doing what Jean Pierre says, you sell out of a good quality business and then you regret it.
Well, it always depends on what size it is of your total portfolio of assets. So if you're heavily overweight, you might want to use some of your overweight position, in other words, sell some and go and put it somewhere else. But if you're comfortable with the weighting in your portfolio, there's no reason to sell it.
Jean-Pierre, before I ask you about your views on Shoprite, a viewer says, spot on, Jean-Pierre. Wayne always says no one has jumped off a building because they realize some profits on selling good performing shares. However, like Jean-Pierre, I've wanted to jump off a building because I realized some profit only to see the share price double after that. But your thoughts on Shoprite? Would you hold it?
I would, because of exactly this theme. One of the biggest wonders in the world is compound returns. It's so powerful. People underestimate a good quality business that can grow its profits at an above average rate over the long term. The compounding of that is enormously powerful. That's how you get 10 baggers and 100 baggers. So to sell out before you let the wonder of compounding do its job is sad. And your opportunity cost is sometimes the biggest loss you will have in your portfolio. You don't see it because it's not in your portfolio, but it's the opportunity you lost by potentially having had that profit in your portfolio. So I would be very sensitive to that and not sell high quality companies, even if they look expensive, unless they become an enormous part of one's portfolio, as Ricus said.
Yeah, okay. Unfortunately, there was a viewer that sent an interesting question on US debt, but I have to get your stock pick. So hopefully he can put it to viewers tomorrow night or next week. So Ricus, what are you going for this evening?
Very exciting. It's Sanlam. Sanlam's had a great run up to their results. Results came out very good. Price pulled back about 10%. I think they're back into a buying level. And the reason I like it is the long-term narrative. First of all, their partnership with Allianz in Africa is interesting. It's at a very early start, but that is going to give them a new vector as far as their income stream is concerned. And then their continued association with and also possible expansion in India through their partnership with Shorian. That's been going on for almost 18 years now. That's been a very profitable association, and that is starting to gain traction and momentum and can become a very big part of Sanlam's earnings. So nothing to write home about as far as their local exposure is concerned, but 4 or 5 years from now, the local exposure might not matter that much, seeing the new markets that are developing into.
Okay. Jean-Pierre, you alluded to Chinese shares at the start of the show. So which is your stock picks this evening?
Indeed, it is a Chinese share listed in Hong Kong, Meituan. You can view Meituan as being the Uber Eats of China. They've got a very strong position in the food delivery business, which is the way in which most people in Chinese cities at least get their meals on a daily basis. But importantly, they also diversified, and they went into grocery delivery, and they went into travel and tourism, and these other ventures have been loss-making, significantly so. And that has almost disguised the profitability of the food delivery business. In the recent results of the past week or so, you've seen that those losses are starting to be curtailed. So if the food delivery businesses' profitability will come through and we're near the point of break even for these other bets that Meituan has made, which has been very costly bets, I think that can lead to very strong profit growth. And after 2.5 years of a bear market in China, I think if you have that inflection where we are potentially reaching in Meituan now, with the turn in the sentiment towards China as well, it could mean a nice opportunity from current levels.
Okay, gents, we'll leave it there. Thank you so much for your insights this evening. Jean Pierre Verster is from Protea Capital Management. Ricus is from PSG Hole in One Ruimsig. Up next, the close. Stay with us.